All right, everybody, back for part 5. I know, 5 parts. Okay. Delivery expenses, seller. So if you are selling products and you have to pay for shipping to get it to the customer, that's a cost of doing business. That's simply going to be a selling expense. All right, we're not adding it to inventory. That doesn't make any sense because we're selling our inventory. Our inventory is coming off of our books. It is a cost of doing business. It is just going to be a selling expense. So let's look at this. Goods sold to a customer, $2,500. Cost of goods sold is $1,000. Terms are FOB destination, which we are the seller. We're trying to get it to the destination, which means we are the ones that are paying for it. Okay, freight cost of $250. So let's look at the journal entry. Nothing has changed, right? Same journal entry. Accounts receivable, sales revenue, cost of goods sold, inventory, right? You made $1,500 on the sale. When you look at these two guys together, that's your gross profit. But we also paid for freight costs. So if that's the case, we are just going to call it a delivery expense or a freight expense or transportation expense. Any of those are fine. And cash. So when we look at these guys together, it's going to be sales revenue minus cost of goods sold gives you gross profit minus delivery expenses. So the net profit overall, the income from operations, would be $1,250. You see how this is a credit balance and these two guys are debits? It's because they're expenses. All right. Okay, I was trying to decide whether or not I was going to do these, but we will do them. And then we're just about done, I promise. Only one more small concept. All right, so this is if you're a seller and if you're the buyer, like side-by-side journal entries, basically, right? Looking at it from the two different perspectives. So on January 12th, $1,500 of merchandise was sold with credit terms $210, net $30, cost of goods sold was $900. So if you're selling, you've got those two sales entries, right? You've got, oops, there we go. We'll get to that discount in a second. Accounts receivable, sales, cost of goods sold, inventory. Nothing new. We don't know whether or not the discount is going to be taken advantage of yet. I just kind of have it down here. The buyer is buying your inventory, so they've got inventory, $1,500. That's what they paid. And they have a payable, $1,500. At this point, nobody knows if the discount's going to be taken. All right. So within 8 days here, January 12th to 20th, so we're within the discount period here, 2% payment is going to be made. So if that's the case, the discount is $1,500 and it's a 2% discount, so $30. So you're looking, the cash they're going to pay, or the cash the seller is going to receive is going to be not $1,500, but $1,470, right? $1,500 minus the $30 discount. You have to take the full receivable off the book, still $1,500. And that $30, oh, wow, wait, hang on. My clicks are out of order. There you go. My $30 is a sales discount. I have to fix that. That $30 is the sales discount. From the buyer side, they're paying $1,470. Cash is cash. The payable that they have, the $1,500, has to come off the books, and they reduce inventory by that discounted amount. All right. Next one, Scully sold $5,000 to Burton for cash, FOB destination. Their freight costs $250. So the seller, if it's FOB destination, the seller has to get it all the way to the buyer, which means they're bearing the costs, which means it's a selling expense. All right. So we have the normal, there you go, cash, sales, cost of goods sold, merchandise inventory. We also have the freight charges, delivery expense, transportation expense, freight expense, all the same thing, right? And cash, because it is just a cost of making the sale. The buyer is just getting $5,000 worth of inventory. That's it. Nothing weird. All right. Let's look at the next one. What if it was FOB shipping point instead? FOB shipping point means that the seller only has to get it to the FedEx truck, and the buyer has to pay the cost of getting it all the way to them. If that's the case, and it costs the merchandise inventory is $5,000, and the buyer had to pay $250, it really cost them $5,250 to get their hands on that inventory. So hold that in your brain for a second. Let's do the seller's entries. The seller's entries, just regular cash, sales, cost of goods sold, merchandise inventory, no change there. They're not paying the freight charges. So we come on over to the buyer side, though. They are paying the freight charges. So the cash that they're laying out is $5,000. There we go. Laying out $5,000 in cash. And that extra $250 is going to be added to the inventory. MI stands for merchandise inventory. And they have to pay the FedEx or the whomever the cash. Okay? So that inventory, if the buyer is paying for it, they paid for the $5,000 and they paid for the $250 in freight charges, then it really cost them $52.50. And when we add these two guys together, that's $52.50. And they paid cash of $52.50. All right, we are not going to do this. This is for my face-to-face class, so I'm going to pause you for a second. Don't you worry, that section I just skipped is the same stuff we've been talking about, but in more than a face-to-face classroom, I have the students do it. So anyway, all right, I'll eliminate that from your handout and make sure I do. All right, so shrinkage. This is the last major concept in here. Oh, kind of. Last major one, the last new concept. Shrinkage refers to inventory loss. Inventory gets damaged, inventory gets stolen, right? That is just the nature of doing business in the merchandising business. So shrinkage is how we account for that. So it's adjusting inventory for losses due to damage, theft, or error. Maybe somebody miscounted, there's your error. Now here's the thing. Inventory count must be done at least once a year, like a physical count of inventory, like when you go out there on the floor and count every single t-shirt and every single pair of pants. All right, that has to be done at least once a year before the financial statements can be issued. Absolute requirement, and we'll talk a lot more about that come chapter 6 when we do a whole inventory chapter. But for now, the piece I want you to know about is what happens if the count is different than what is in your records. So look at this first example. Inventory ledger shows you have $500,000, right? So our paperwork, our books say we have $500,000. We go out there and physically count all of the inventory on the floor, and we only have $490,000. $10,000 of inventory disappeared, whether it's shrink, like whether the shrink is due to damage or theft or whatever. Point is you're off. That's somebody else's job to figure out where it's going. Our job is to record the $10,000 difference. So if our records currently say we have $500,000, we've got to bring that down by $10,000 so that the count, the amount that we have on hand matches what our records have. So if that's the case, there you go. We are going to reduce our inventory by $10,000 with our credit here. And like I said before, cost of goods sold is kind of like inventory expense. It's just a cost of doing business. You know, you expect a certain amount of shrink in your inventory. So this is like an expense, an inventory expense, and we're basically just increasing the expense. It's just it's more of a loss. Not a loss, but a higher expense. All right, so we debit cost of goods sold, credit merchandise inventory. All right, so if you want to pause me and you can look at this one and try it on your own. The journal entry stays the same, but look at the dollar amount, $61,900, $63,000, what is that, $1,100? We would do the same thing to bring it down $1,100 in that last problem. All right, the very last thing, promise, the closing entries. So we do the same thing that we did in chapter 4 for closing entries. Revenues gets close to income summary, expenses get close to income summary to retained earnings, dividends to retained earnings. It's the same exact process. The thing is though, we have more revenue accounts because not only do we have to close sales revenue, we've got to close sales discounts, we've got to close sales returns and allowances. So you have a couple of those three accounts that also have to, well, the two additional accounts that also have to be closed in that first step. But otherwise, it's the same thing as it was in chapter 4. And cost of goods sold needs to be closed with the expenses. All right? Happy merchandising.